Investors around the world are now looking at the 54 nations that make up Africa with fresh eyes. Tens of billions of dollars have poured into African industries this year as government bodies and businesses across Asia, Europe, and the Middle East look to tap into the continent's young population and rapid economic growth. According to a report, China alone inked more than $30 billion in construction contracts across Africa in the first half of 2025, which is 5 times more than the same period last year. The appeal is clear. Africa is home to the world's youngest population and some of the fastest growing economies. Today, the continent is home to 1.6 billion people, and by 2070, the UN expects this number to more than double to 3.2 billion, which will contribute to the region's growth prospects.
By 2050, Africa is expected to have 2.5 billion people. That will account for 1/4 of the world's population, but there are too few jobs. Unemployment is high in South Africa. About a third of the labor force is unemployed. In the rest of the continent, the majority of young people are forced to find jobs in the informal sector. Trade deals that would help Africa secure investments, particularly in the manufacturing sector, that absorb this labor would help in terms of accelerating growth on the continent.
The African Continental Free Trade Area, which was officially introduced in 2021, is expected to be fully operational by 2035 and is forecast to become the largest free trade bloc in the world, unlocking access to a $3.4 trillion market. But every boom has its bottlenecks. According to the African Development Bank, the continent faces a massive infrastructure financing gap of as much as $108 billion a year. Policy uncertainty, skill gaps, high youth unemployment, and rising debt burdens are also challenges many economies are facing on the continent, making it tougher for foreign capital to find stable footing in Africa. To help understand where investors should deploy capital, Bloomberg Economics developed a riskometer. It's a scorecard where countries are rated based on their economic and fiscal strength, governance, infrastructure, and external vulnerability.
On our riskometer, we found that the countries with the lowest risk were South Africa, Botswana, and Mauritius. And there was a common theme for that. Firstly, we found that the institutions and governance were strongest in those 3 countries compared to other African economies. Secondly, the infrastructure was by far more superior, particularly in the case of South Africa, which is the most industrialized economy on the continent. The countries that had higher risk on our riskometer were the likes of Mozambique and Senegal. And the reason, and of course the Democratic Republic of Congo, the reason for that was the flip side for the low-risk countries, which was poor institutions, particularly in the case of the Democratic Republic of Congo. Also, the infrastructure was is a lot more poorer in those economies.